median home price is this. Hey guys, it's James Dainard with Heaton Real Estate, and we are diving into our monthly market update. So we're going to be doing these every month. We're just going to recap what's going on with the latest trends and what's happening in our local King, Snohomish, and Pierce County markets. That's primarily where we do most of our business at Heaton Dainard. So that's what we're going to be recapping. So we're going to dive right into this. We're going to do a 30-minute kind of overview of where the stats are, what's going on with the trends, and then we're going to open it up for questions at the end. And how you guys do questions too is you just put it in that little chat box right next there, and then we'll go from there. This presentation is being presented by Project RE, our YouTube channel, which gives out free education, Intrust funding, our local hard money company in the Pacific Northwest. We fund a ton of fix and flip transactions locally in King, Snohomish, Pierce County, and throughout all of Eastern Washington as well. Definitely check us out at intrustfunding.com. And then for wholesalers and brokers trying to get more leads in the door, EasyButton Leads is our company that actually generates a ton of different lead flow for us internally. Basically for a fraction of the cost, typically you can generate, 20 to 30,000 calls a month to kind of get your business going. And then Heaton Dainard, our real estate brokerage. So as we get going, quick thing about me for those who don't know me that well, I've been a full-time investor since 2006. We've gone through all different types of market cycles, ups, downs, accelerated appreciation, accelerated depreciation, and then we've just been active investors in every type of market. We're also known as the recession flippers because we flipped hundreds of homes through 2008, 9, and 10 when the market was going down steadily. And then with my partner, Will Heaton, we have flipped over 2,000 homes together, and we've done about 3,500 transactions direct to sales with investors on the acquisition and disposition since starting our business in 2010 as the brokerage. And since founding that business, we've done over $1 billion in sales. So we have a lot of different market knowledge. We're active in each market, and we kind of know what's going on in every little nook and cranny because we have listings in all spots. So what we're going to cover tonight is 2022 first half. So we're just going to we're going to go over this almost every monthly report, just because it's good to remember what we saw in 2022 and why the market is shifting right now and what it's doing. So we saw a rapid increase, and that's kind of coming down the other way right now and leveling out. We're going to cover King, Snohomish, and Pierce County and the stats and what's going on today, and then interest rates, where they're at, where they're forecasted, inflation, and investment trends, because all those things matter to what we're doing right now. So we're going to dive into the Tri-County quarterly report. So as we kind of covered last month, King County home price through the first half of the year, the median home price had ballooned up to about $900,000 or 890,000. That was a 13.8% growth in a very small amount of time. In Pierce County, the median home price went up to 575, which was a 15% growth year over year. And Snohomish County was ballooned up to 780, which was a 20% increase. It was actually the highest appreciating market at the time. A lot of that had to do with the pandemic, a little bit more space out there. So it just kind of grew very rapidly. One thing to also note too is you guys, this is a massive amount of appreciation after a 18-month run too that was already up 32%. And so what we've seen is we've seen this massive appreciation, and now we're starting to see the pullback going on. And that's because the cost of money has increased almost 50%. It is way more expensive to borrow money right now, which is going to naturally start to pull things down and kind of slow down our economy. So currently in the third quarter, the pullback, the median home price for King County is 803. That is still up 6% over year for where we're at. And that is one thing to notice is because that is actually still healthy growth. The average appreciation for the last 20 to 30 years is roughly about 3 to 3.5% appreciation. And so these high spiked markets and high appreciating market at 15% year over year, that's just not reasonable. And so the average is about 3.5% on a 10 to 20 or 20 to 30 year basis. Medium Pierce County sale was up to 537, which is still 5.9% year over year. And Snohomish County is at 725, which is still an 8.2% year over year. So as you can see, what it happened in the spring is it spiked and now it's just pulling back. So let's talk about Washington State in general to see if the counties are kind of doing all the same. So what we always like to do, we're main investors and brokers in King, Snohomish, and Pierce. But we also want to make sure that our tri-counties either we want to know if it's overperforming against the rest of the state or is it kind of staying in trend. And in Washington State as a general, just kind of all staying together as one big market because the trends that usually are going to stay about the same during a transition market. So home prices in Washington were up 5.2% year over year as of right now. And so what we've seen is actually the King, Snohomish, and Pierce County are actually still above what the average is over Washington State in a lot of those other affordable areas. But we've seen the whole market kind of just cool down. At the same time, the number of homes fell 30%. And the amount of inventory increased by 78.7%. So what we're seeing right now is the market's cooling down and the inventory has increased by almost 100%, and the number of transactions are going down just because based on the affordability. So what that's going to do is it's going to cause longer days on market. Days on markets are now up to 28%, which is a 100% increase. Prior, back in June, we were roughly year over year, or in Washington State, we were actually around, like, I think it was around 11 days. So we've seen a big increase in that. The good news is 28 days is still not a long time. You know, typically on average, it takes like around 60 to 90 days to sell a house in a traditional market. So what we're doing is we're seeing that things are leveling out. We're just going into a more traditional, regular market. The median home price in Washington State went up to 589,000. Or went from 589 to 620, which is still up 5.2% year over year. And then one thing to also note, guys, right now, because what we've seen is we've seen this kind of pullback and people are pricing based on comps that were back in the spring, is we have seen 37.7% of homes sell below list price. Now, that doesn't mean that the market is declining rapidly either. What that also means is people are just pricing heavy and people are a little bit behind on the pricing and they may be using old data points that are just not relative anymore. I know at our brokerage, we only use 30 to 45 day old comps, or we might go a little bit further back because we want to use data points that are actually in the current market with the current rates. If we don't do that, we're going to be overpricing, and that's where these houses are selling quite a bit off list. So King County inventory is up 171% year over year. So what that means is, you know, we've gone from having inventory, we had about a supply of less than 2 weeks on the market worth of inventory. Now we are up to about 2.5 months worth of inventory. So that is where the massive increase is. The one thing to really think about, though, is that 2.5 months supply of inventory is still below what it would be to start traditionally declining. Typically, on average, it takes 5 months of inventories for the market to start going into a decline. So what we've seen is the decline is actually more off affordability and that spike, and then we're still above the median home price year over year, but the transactions have slowed down, and we're just getting into more healthier market. The numbers of sales have decreased by 33%. So there's less buyers in the market and less sales are going down with more homes for sale. The days on market are up 100%. They went from 13 days up to 26 in the last month. And so again, we're getting close to that 30 days on market. So for investors, what we've been doing on our side is we're actually just adjusting our performas to where we're adding an additional month or two onto our performa. So if our average flip for 2021 took an average with our clients and ourselves of 5.1 months to flip that house. That's from purchase to sale. So based on that average, we've always kind of ran our performance at a 5 month carry to 5.5 or 6 month carry. So now what we're doing is we're running at a 6 to 7 month carry to account for that extra debt cost. So as we go to sell other properties down the road, you just want to account for that extra hold and that extra day worth of time. And then over list, percentage over list. Now, this does still happen. We did sell a property for about 5% over list just recently, but the amount of sales that sell now over list is down 5.8%, which makes sense because when these properties that we were selling in the spring were selling, almost every property was selling over list, and there was 20 to 30 showings in a weekend. There was a massive supply issue, and there was way more buyers than sellers. As the inventory starts to increase, we're going to start to see that kind of pull back. And in addition to the cost of money is so much more expensive that's where you're going to see the percentage of a list drop as well. So let's look at Pierce County. So inventory in Pierce County is up, but it's not up as much as King County. So inventory is up 75%. And so again, it went from having roughly about 3 weeks of inventory on the market to now it's about 2 months. The big difference on Pierce County really is it had about 35% more inventory than King County in general back in the spring. And so we've seen about the same amount of housing supply on the market. It's just been there was already more homes available at the time. So inventory is up 75%. Numbers of sales decreased. It's about the same, about 31.7% year over year. And so we've seen this steady slowdown, King, Snohomish, Pierce. They're showing the same type of metrics, the same type of buyer activity that we've seen, about 30% less sales in Pierce, just like King. And then days on market are very similar as well. It went up 107% and went from 13 days to 27. So what we're seeing is we're just seeing everything balance out. And we're also seeing these trends across the board. So what that's telling us is no market is more protected than the other. This is just showing that with the Fed increasing the interest rates and the cost of money, that it is equally affecting each type of market at this point. The main difference is the amount of sales in the carry times is in King County. The cost of money, the cost per deal is just more expensive. So you might feel it a little bit more. So as you're kind of looking at future projects down the road, areas like Pierce County are a great place to be looking, right? They're cheaper deals. They're following the same trends as King County. And as long as we adjust our metrics on the front side, everything's going to be good. Okay. Also, what we've seen is that the percentage of list is also down 3.2%. So what we have seen is we've seen people be a little bit more aggressive still in Pierce County. Things are still selling a little bit above list. Part of the reason that is a lot of the buyers are asking for closing costs right now because the cost of mortgage is so high, or they might want some sort of rate buy down. And so what's happening is a lot of these offers, even if they're writing them at list, they're coming up a little bit above just to cover the carry costs. And that's all the negotiation. So that's one reason we've seen the percentage over list be a little bit better in Pierce County. It's kind of more the buyer pool. In Snohomish County, we've seen inventory again increase by 109%. The numbers of sales are about the same as what King and Pierce were doing, down 32%. And then days on market were from 11 days to 127 days, or to 27 days, and that's up 145.5%. And the amount of properties that were sold over list were again down 5%. So we've seen kind of a drop in Snohomish County a little bit more aggressive, and the reason being is it had the highest growth too. So King and Pierce and King County were up about 15 to 16%. Snohomish County was up an additional 5%, around 20. So we're seeing a little bit more of a pullback on there. And that's also because people, as things are coming back to life with the pandemic and people are going back into urban cities, we're seeing that the demand for larger lots is starting to slip a little bit. About in the spring, if you had a large lot, or anytime during the pandemic, if you had a large lot with a staycation feel, you were going to get paid a premium for that property. And that's why the growth was so aggressive. That's what people wanted to buy. As things normalize out, people are realizing they'd actually rather be closer to the city, closer to things. And so that's why we're seeing a little bit more pullback in Snohomish County. All right, so our listings at Heaton Dainard, because we like to put this out there as well, because again, we have over 70 listings in all three counties, King, Snohomish, and Pierce. There we have inexpensive properties, and we have very expensive $4 to $5 million homes as well. So our average showings per week right now are ranging about 2 to 3 a week. Now, every once in a while, like we just listed one in Sammamish, and we got 8 showings, but we also kept the pricing right where it needed to be to get the high activity. So for us, if the market in all different sections, whether all different price points, is averaging 2 to 3 showings a week, that's where we're kind of basing our activity off of. So if we're seeing our suggestions and pricing conditions off there, if we're getting that 3 showings, we're staying pretty steady on our pricing. If we're slipping down to 1 showing a week or maybe 2, that's where we want to start looking at where we might need to correct to kind of get to a healthier spot. The biggest key on this too is just communicating with other working professionals and brokers in the market. Every Monday, we're talking to every broker in the market. We want to know who is listing a property by ours. Are they getting the same amount of showings? If you're not getting the same average showings as the rest of the inventory in your local market to where you're selling, then you need to look at maybe correcting the price or being in this for a little bit of a longer hold at that point. Typically, if you don't want to work with the price, you are going to be on market longer, and you have to wait for that right buyer. 45% of all of our listings are pending right now. So we are selling a lot of homes. We're still moving a lot of inventory, but we're having to make sure that we're staying in front of pricing. We're not chasing the market. We're staying ahead of it. Our average days on market right now are at 45 days, which is above the median price, mostly because we're dispositioning and selling a lot of properties that were based off the spring comps, and we've had to kind of adjust down from there. In addition to, we've had some more expensive listings that have been above 2, 3, and 4 million that are just taking a little bit longer. Most of the median home pricing that's selling in that first 14 to 21 days are kind of around the median home price. If you're well above, like when you're selling $2 to $3 million product, or 4, or even higher above that, that has been even longer. And so one thing I would do want to encourage is whatever market that you're playing in, or whatever kind of property that you're about ready to sell, whether you're a homeowner or investor, break the stats down a little bit more on where is the days on market for your current inventory. Those are the stats that we're always looking at, because we want to make sure that we have the right expectation and that we make the right price cuts or price adjustments when we need to. If my average days on market in a neighborhood are at 45 days and I'm only at 21, and we're getting a steady amount of showings, I'm not really going to touch price, because that's telling me that it takes about a month and a half to sell that house in general. And so those are things that you want to be looking at before you make your price adjustments. And then right now we're selling most properties, and we're trending right around 5% of list price. So we're getting a lot of offers, especially recently. We get a lot of low offers right now because there's a lot of opportunistic buyers out there, but we're ending up and landing around 5% of list price as of right now. So let's look at the interest rates and inflation. So what came out recently, which was not great news, is the inflation report came out at 8.1. So one of the biggest things, though, is they took out the variable, and or in August, it was 8.3. In September, it rose to 8.5. And they actually pulled out the energy and housing sector, and that increased even further than that. And so the reason we're tracking the inflation report so heavy on this is that's really going to have to do with what the Fed's going to do with interest rates, the cost of money. Cost of money is going to slow down. If we increase the cost of money dramatically or keep increasing it, it's going to slow down the economy, slow down housing, and slow down everything, not just housing. And so we're constantly watching this, because the Fed is going to keep stepping on rates and adjusting things and putting different types of policies in play until they see that start to drop down. We were seeing that slow down throughout the summer, but it's kind of hitting a bottleneck at that point. And so what that means is rates are probably going to stay high for a minute until they get this under control. Um, so interest rate review. So with them stepping all over rates, where are we at right now, and what is that doing to the market? So right now, the cost of mortgage is up 40% to 45% on affordability. Larger increases, the increases have been much higher than they were predicting at the beginning of the year. If you remember correctly, the Fed said that they were going to be increasing rates. They were going to do about 5 to 6 rate hikes, and they were going to be roughly around a half point. They changed their mind. Now they're doing 6 to 7 hikes. About mid April, they started rolling this out, and they went to 3/4 point hikes, which has made a huge difference. So the federal funds rate went from being right around 0% all the way up to 2.5%. The August residential, which this has increased our rates dramatically. So the August residential interest rate was at 5.66%. That's why we saw a little bit of a surge in the market in the last August. I know we sold a ton of properties in the first 2 weeks, 2 to 3 weeks in August. What we've seen today is it slowed down again, partly because of seasonal, but also partly because now the residential rate is now 1 point higher. It's at to 6.89%, which is about 1.2 points higher. That affects the affordability on housing by 10% in a very short window. So your cost of mortgage went up. If you're paying $600,000 for a house, you now, to have the same cost of mortgage, need to pay right around 550 for that house to 540. So that's why we've seen the slowdown. The 2022 forecast is they are doing another 2 3/4 point hikes. Now, these rate hikes, the first one is already built into this 6.89 pricing. But based on the Fed coming out and saying they're doing another one when he speaks next, that could increase another 3/4 of a point based on today's rate. And also depending on what the bond market is doing. So we may have rates by the end of the year around 7.5 to 7 3/4 points, which is higher than they were in 2008. Um, the one thing to note though is we've seen the cost of money increase dramatically, but what we haven't seen, we've only seen sales fall off by 35%, and we've seen a pullback. We haven't seen a huge crash or corrections. We've just seen everything start to normalize out, which is healthy. That's what we actually want. And so what that is showing is that our economy is strong. There's people with a lot of money in our local market, and that things are still moving for above what they were year over year ago. But we are going to see things slowing down. It is good news that we've increased the affordability of the mortgage has gone down so much, and the market has only pulled back around 10%. That's not that detrimental for what the actual cost of money is. So I would anticipate the market to continue to be slow for the next 12 months or so until they get this inflation and rates under control. All right. So again, you guys, this is what I was just talking about. So things that we want to kind of point out. So right now, the single family primary residence, if you were buying a property in January at 3.25%, your payment was 43.52. It is now it's actually above 6%. The payment is over 6,000, or it'll be around $6,200 a month. So that's an increase of around $1,500 a month per family. That's a big cost increase. On rental properties, 1 to 4, $1 million purchase. January was 4.25. Now it's actually around 8%, not 7, and the payment's going to be around $7,400 a month, or $7,200 a month. And so in the investment sector, that is actually slowed down the multifamily purchasing quite a bit. In addition to construction costs being high, it's really slowed down value add sales on multifamily. So if you are a multifamily investor right now, it's actually a great time to be getting in, because you can pay a good price for these things, or get them close to replacement costs, get your cost per door way down, stabilize the property, and then wait for rents to fall down. And you can actually yield in very good markets on a tier. If the rates go down by, let's say, 2 points in the next 2 years, you can get into A-class neighborhoods or prime areas where the cash flow might not look good today, but it's near impossible to cash flow like in a prime downtown Seattle, prime Bellevue neighborhood, and get around a 10% cash flow. When the rates come down 2%, if you're making a minimal cash flow right now, it's going to actually shoot you past that 10%. And for the last 2 years, all I've heard is you cannot cash flow in an expensive Seattle market or get a really good return. What this is doing is it's allowing more inventory to come to market. You can buy it cheaper. You can put the cost of money that's around 8% on it, ride it out for 2 years. And once the rates drop down, your portfolio is going to be around 10 to 12% because it's going to automatically increase your cash flow by the debt costs going down. And so there's a very good opportunity in that space right now to pick up long-term holdings. I know we're gearing up to buy a bunch of it. So impacts on rates there, everyone needs to expect longer market times. And again, it typically takes a house around 90 days to sell in a traditional market. So the fact that we are still below 30 right now means that we're in a healthier market. How you kind of plan for that is you just add more expense to your pro forma, increase your market times, increase your debt times. Other things that you got to watch out for is irrational price drops. We have a lot of listings in King, Snohomish, Pierce County, and we've seen where people start to panic and they cut price rapidly in a very short amount of time. If the average market time's 30 days and they're cutting price by $100,000 or 10% on a house after a week, that means they're not reading the data right. And so you do have to watch out for sellers and brokers that might not be actually paying attention to what's going on in the average market conditions and cutting price too dramatically. That is a factor when you're trying to sell a house. If you have people dropping below you, it makes it hard to move your property. So be on the lookout for those irrational price drops. Buyers are very selective right now. If your property has, you want to make sure that your properties are punched out, they're priced well, and that people feel really good about your property. Adding a little bit of extra flavor in your house or staging it and getting it all cleaned up and perfecting it is in your best interest. You want your first impression on that home because there's a very selective amount of buyers out there right now. You want it to be a good one as they're coming through. And then you just got to be patient. Showings have reduced 90% in the last 90 days, and that is okay. But you got to work with the buyer pool that's there. Even this last home that we sold in Sammamish, we had two interested buyers that both wanted to write it up. They both were coming, and that sold within the first weekend of us pricing it. And we didn't need 100 people to come through this house. We just needed the right buyer that liked the house, that liked all the finishes that we did, and we sold at full price. So as long as you're pricing it well and your house is all punched out, you can sell things pretty quickly. And in Sammamish, guys, that there was a dramatic amount more inventory in it wasn't up 100%. It was up like 200% in our specific neighborhood. And so by us selling it in the 5 days just means we're putting the right plan on pricing these. So what are we doing on our investment side is we are increasing hold times. We are factoring for longer deals, longer cost of money. Longer market time only really affects you if you don't account for the cost of money and if you don't look at the annual return at that point. So as long as you're looking at your deals in the right way as you're going into them, everything will be fine. We're still putting construction contingencies on everything, 5 to 10%. But what we have seen is pricing is starting to come down in the construction side. So again, as the market kind of cools down and everything gets a little bit more healthy, you want to we're starting to see other things also cool down. Construction, guys are reaching out to me a lot more looking for work. There's less demand for construction. So the market may be cooling down, but we know over the last 24 months, construction has been a complete nightmare. It's been hard to get guys. They don't show up. You pay them money. They do okay work and then they don't come back. That is going to change. So yes, it will be harder to sell, but it should be a lot easier to fix them in the next 6 to 12 months. And then also we're using cluster comps. We're not going for that peak high comp. We're not looking for that brand new data point that resets the market. We're going with where the movement is. If there's more sales in a certain section, we're going to put our plans in behind that priced area, and we're going to work with that area because that's where the biggest buyer pool is. And then we've increased our returns to go from 12 to 15% to 16 to 20. That extra padding, the extra return is really giving us that bigger margin to make it safe to continue investing. So what we're going to do now is we're going to open it up for questions. And you guys, the purpose of this every month is we just want to keep in with the trends. The most important thing you can be doing as an investor is seeing what's going on in the market that you're playing in. It doesn't really matter nationally what's going on. For me, it doesn't really matter what's going on in Eastern Washington because I'm not a buyer there. I'm looking at what are the neighborhoods doing that I'm in. I'm breaking down every neighborhood that I'm looking at buying in, and I'm just putting my pro forma and my expectations into this deal before we purchase. So we're checking days on market, median home price, trends, and buyer activity before we buy any deal. If it's slow or things aren't moving quick, then we're just being more conservative. So communicate with everybody, read the trends, and that's what this monthly presentation is about, is to kind of just give you guys the broad trends, and then you can kind of dig into each specific neighborhood that you're messing in. So we're going to open it up for questions, but for more stats and facts, guys, and just market information, check us out on the Instagram at Heaton Dainard and J Dane Flips, or on my LinkedIn page. Also, for more free education in construction tips, go to our YouTube channel at Project RE, and don't forget to follow the Bigger Pockets on the Market podcast that we're on. You guys, this is the best podcast out there. I'm saying that also because I'm on it, but that's all we talk about is trends, what's going on, and how do you forecast down the road to make sure that your investment's safe. So make sure you check out the Bigger Pockets on the Market podcast, and also make sure to leave us a 5-star review if you can. I would greatly appreciate it. So our first question is, we're going to open it up for questions. I will stay on until everyone has got them out. So the first question is, any thoughts on Thurston County? From what I understand, Thurston County, it's been doing about the same as Pierce. I think you're seeing the same kind of correction is what's going on there. There's more inventory on market. It's kind of getting pulled back with the interest rates. I know the more affordable product has been selling pretty well there. We do a lot of hard money loans in Thurston County, and our borrowers have been getting in and out of their deals pretty quickly. I think the cautious thing is to just watch out for the expensive product in that area. The cost of money has gotten really expensive. And so, these homes that have been going up into the $1 million range, that is very, very expensive for what the median income is for Thurston County. And so I would kind of watch that. You guys, that's a great thing to look at. Look at your median income for areas, and then look at your median home pricing. And you can also look at what's the mortgage payments going to be. So if you really want to kind of dig a little extra deep into a deal, you can look at a house, look where the median home price or median income is for that area, find out what their monthly income is by dividing by 12. And then as you're looking at deals, if your mortgage cost is at 50% of that, then you're actually or less, you're in a pretty good range to be selling things. If your mortgage cost is above 50% in the median home price, then that is going to be an issue, and there's going to be less buyers in that area. So that's something that you can always be checking. All right. Any more questions, guys? Wow, I get rattled with questions all week. And now everyone's being shy. Okay, another question is says, thank you for offering this webinar. When investing in the Pacific Northwest, what are the top 3 criteria you look for when deciding to invest? And does that change based on the economy's doing? That's a good question. So when investing in the Pacific Northwest, our top 3 criteria, it depends on what it is. So we're really active investors. We're developers, we're apartment syndicators, and apartment buyers, and flippers. And so the things that we're looking at right now, like for our buy and hold, we are looking at a deal that we just locked up. We got it for a cost per door that we haven't seen in over 4 to 5 years. And so we're looking at the cash flow, we're looking at the income and the internal rate of return. But we're also looking at the key metrics of replacement cost and cost per door, because we have not been able to touch that. And we know we can't build that product for that pricing. So a lot of times when we're going into a slowdown, when I'm looking at my holdings, I'm looking at for those extra opportunities. So I'm looking at, can I buy it below replacement cost? Can I buy it cost per door historically lower than I've ever been able to get it? And then the other thing that I'm looking for on my holdings is is this going to cash flow above a 10% return after 2 years, when I figure that rates will be in the high 5s? If the deal is cash flowing above 10% on a high 5 rate, the rates could go down to low 5s, which will put me at like a 12 to 13% increase at that point. And so those are kind of metrics that we're looking at for the buy and hold, and whether I'm going to make that decision or not. Things that we're looking at for the fix and flip, we're trying to stay within a 20% return in a 6-month window. If it is a major fixer and we're taking this thing all the way down to studs and rebuilding the whole thing, we're chasing 35 to 40%, because that's our annual expectation. So we're going with more padding in our performa, and does it, whether it makes money or not. The other thing that we're doing is we're playing in all markets. I don't really care if it's cheap or expensive. It's just a matter of what's the buyer activity, and then how big is the performa, and how big is the padding on that. So for the fix and flip, it doesn't matter what it is. If people are looking for lower, risk deals, we're very experienced, so we kind of play in all markets. But if you are a flipper and you're looking to be kind of in a lower risk deals, then you want to target the cheaper stuff that you can refi later and keep it just in case you need to. The one thing about the expensive deals is it gets harder to keep them if the market's not turning out the way you predicted. And so buying cheaper deals is another good thing to be doing. For development, we're only closing on permit right now. We're not closing early. Just not worth it to us. The cost of money is too expensive. We're subject to market changes. And so we want to control that deal, get it through permitting, and then get building immediately. Another question is, how far back into 2021 do you feel you need to go to comp accurately? That is a great question. I actually don't use comps in 2021 right now, because if we look at the median home price, it's up 5%. So typically we would go back towards the end of the last fourth quarter, or you go year over year, and we're about 5% above that. Based on the cost of money being increased, I don't think that trend's going to hold. So what we've been doing to evaluate properties is the first initial step is we're staying very tight on our radius, staying within blocks within less than a quarter mile in each house. Then we're pulling only the actives, pendings, and solds in the last 45 days. We don't really care what's really happening past there because the rates were completely different. Even if we're looking at comps about 3 weeks ago, the cost of money was about 10 to 12% cheaper. And so what we're really leaning on is our actives and pendings. What's going on? How many people are coming through? Are they pending at list? Is it fully stabilized? Is it fully renovated? And if it's hitting all those metrics, we're adjusting the values down. So if I have a comp that is 45 days old that's at 600, but all my pendings are at 580, I'm going to be adjusting my comps or my evaluation down to 580. So I'm trying to stay with the market and the activity. And that's because as the cost of money keeps increasing rapidly, the market's going to keep sliding. So the only way to stay in front of that is to use the most recent pending activity in sales. Another thing that we're doing is if brokers are only getting like one showing a week and they're priced at a certain thing and there's no other really inventory, or if they're priced at a certain price and there's no other inventory really for us to kind of gauge that off of, we're knocking about 5% off that price. All right, any other questions, guys? If you guys fill up my DM box with questions after this, you might not get a response. Other things too, guys, that we're doing right now, we're writing a lot of offers out there. We want to go, there's some other really good opportunities out there right now. Part of it is the single family homes on development style lots. Things like RSL weren't in really high demand the last 12 months, and it kind of fell off with the permitting and just there's a lot less demand for that product from builders right now. And so what we've seen is some of these homes that are smaller, 900 square feet, they're selling for pretty reasonable pricing right now, to where you can get a nice big development RSL lot, buy it, keep it, break even on it with the high rates, and then refi it later and get actually about a 8 to 9% cash flow once rates fall down. And then what you're doing is you're building your portfolio out with an actual asset that has a high potential of growth. That's where me and Will did so well in 2008, 9, and 10 is we bought the right rental properties. We weren't just out buying single family houses just to get cash flow. We were doing some of that with the equity position, but most of them were targeting something that had upside. What can we build on it later? How can we maximize this value and increase this property more rapidly? And as the market turned and the cost of dirt became more expensive, it really hyper accelerated our portfolio. And so there's a lot of gaps right now in the market where you can pick up some good buys. Another question right now is, in what area of real estate do you suggest a newbie starts right now? I would say it kind of depends on your location and in what you're trying to accomplish on the long term. I don't think that that's an answerable question for a new person. It really depends on some core things. How much cash do you have, and what kind of return are you trying to get? If you're starting in fix and flip or even burr, I would suggest going with a smaller rehab project because time can be a killer right now. And if you don't know how to renovate these properties and it takes you a lot longer, rates can adjust on you, markets can adjust, it can affect your same core numbers all across the board. So stick to stuff that you know or that is easier to do. Right now, I am only buying properties with when I have teams ready to stabilize and fix that property. If I don't have a construction team ready to go, I'm not buying it. I don't care if I have money in the bank. I'm not buying it unless I can jump on it right away because I want to keep the property moving forward. I want to mitigate my risk. So same thing with a new investor. If you're new and you're learning this, which we all learn at some point, it's going to take you a little bit longer. So stick with a little bit simpler, basic ones. Another question is any advice on how to speak to sellers that are behind on price adjustments and still pricing based on off older comps? That's a great question. So what we've been doing at our off market company is we're just trying to educate people. One thing is as a wholesaler, investors are being patient. They want to buy a good deal. They should buy a good deal. The market's a little riskier. And so as a wholesaler, if you're working with that or a buyer, you know, that's okay. They're not ready yet, and they just need to get caught up with it. So we're giving them fats and stacks, though. So if their property, let's say, is in Bellevue, Washington, and the Bellevue, if there's a 12-week trend in Bellevue that's showing that there's been a pullback or a decline, we bring them that information and say, hey, we want to know what that looks like, or we want them to know what's going on in the market. We also want to let them know that we understand that the comps were way higher in the spring, and we want to we a lot of times we actually pull up a mortgage calculator and show them what the difference in payment is from the spring today to when it was back in the spring, and we show them the math on paper of how much more expensive it is. um, we also tell them kind of what the forecasting is. We give them the forecasting for real estate. It is, I mean, people are forecasting that we're going to have a pullback and that things are going to sell for less. And so, um, we give them all this information and it's just a slow sell. We just want to educate people. Our big thing when we're doing off market deals is we don't need to do that deal or not. We want to see if we align with that seller. We can do a certain type of offer where cash, quick close, no BS offer. We also will buy on any condition. That's not for everybody right now. And so we add value and we are giving a service to these sellers. They might not like our number right now, but we're basing it on logic. And so we'd like to give them all that logic and we'd like to educate them and show it all the way through. In addition to every time the rate moves, we call them and say, hey, look, we just want to update you in our price. So if we give a seller an offer and the rates go up a point, and we let them know, we give them the offer, let's say they decline. We say, well, right now we're going to be good with our offer unless rates go up. And if the rates go up a point, we're going to have to bring our offer down 10% because we show them the affordability factor. So that's actually when we do our check-in. So if the Fed comes out and let's say the rates go up another 3/4 of a point this week, we're actually going to call every seller we're talking to and saying, hey, I'm sorry, we are adjusting our numbers now down based on the rates. In addition to, they said that these rate hikes are planned ahead because what it does is it puts them in the reality of what's actually going on. They need to know that you're not just giving them a number just to give them a number. You're doing it based on logics, metrics, and math. If the cost of money goes up, the price is going to come down. And so we just constantly check in with people and tell them and keep and stay in tuned with them. And as they see, we're just shooting them straight. It actually goes fairly well because people are like, yeah, you're right. This is not going well. And we've been doing a lot of deals on the third or fourth presentation of an offer. Also, too, there's a lot of people still out just like bidding things up right now with off market sales, and then they end up walking away. We just locked up a deal under contract where they sold it 4 times before they came back to us. And the sellers, these poor people, just wanted a good, dependable offer, and people were just telling them whatever. So if you are a wholesaler, make sure that you're tying that property up at the right price. Like, don't waste people's time. Burning people's time right now really burns them down the road. So just give them the straight answer on it. Another question is flipping a duplex in Auburn, trendy, easy upgrades, easy to appeal to an investor or house hacker. Um, so you're asking what people want to see. So what I would say is if you're flipping a duplex in Auburn, you want to make it bulletproof. You want to make it to where deferred maintenance is not going to be an issue. So we put in LVP flooring. We still put in new cabinets and counters. It really depends on what price point you're going for and what you're trying to accomplish there. So if you're, a lot of time, and you guys, if you are flipping a duplex or any multifamily right now, it does sometimes pay to leave one unit vacant and really trick it out because as people are trying to figure out how to live in more affordable housing, leaving that one open unit allows people to buy that and subsidize their new mortgage cost with the renters in there. And so that I would suggest, if you are doing multifamily, leave one unit vacant, make it a little bit nicer. That can be the owner's unit, and it gives you a little bit more versatility and get more people to look at it. Because right now, 2 to 4 units, if you're pricing high or flipping it, there's not a lot of buyers right now out there for that. No one wants to pay a premium right now for multifamily with the cost of money being above 8%. It just does not pencil. They will not want to buy your property and lose money every month. So I would leave yourself an out to where a homeowner that may be getting priced out right now because of rates has a shot at still owning a property, and they can subsidize out their cost. So like on a mid-5 exit. So if we look at that right now, I would let's do this as an example. So mid 500s, this is 550, and the rates are now. So back, if you had a loan amount for 500 grand, if they put 10% down, or let's say you took a loan out for 500 grand, back in the spring, their payment would have been 2,300. So right now, if there's an investor, they're at 3845. And so on a 30-year fixed. So on a duplex, that them putting down roughly, that's going to be them putting down roughly 20%. That's about 100 grand down. And so each unit is going to need to rent for at least 2 grand, like I would say $2,300 for anybody to rack a return on that. And so that might be a little aggressive depending on your unit size. So it's going to be a little bit more difficult. If you are targeting investors, try to make it to where it's more affordable. Keep your costs down, get it to market, that they have a good rental, but don't blow your budget because they're not going to pay you back for it. If you're going to target that homeowner, which might be a good plan on this because they can subsidize 50% of their mortgage costs at that point, maybe trick out one and keep one more basic. All right. Any more questions, guys? We'll give it 60 seconds more for questions. If not, we will let you guys go. Just real quick, you guys, like what I just talked about. As the market transition, you have to switch your plan up. So just watch your properties, watch your pricing, see the activity, and you might need to change your rehab plan right now. We've done that quite a bit. I mean, there's one in Capitol Hill where I was planning on going full meal deal on it, and I shredded my budget down by $100,000, and we're going with a different plan at that point. There's another question. Another question is, what are good strategies for investments in general? Apparently, numbers don't pencil out for multifamilies and long-term hold. Does single-family flipping the best strategy in the economy? You guys, every strategy is good if you buy it right and you run the right mathematics. We are actively buying a large apartment building right now, an 80 unit. We just contracted 2 flip properties that we're closing on ourselves. We purchased 3 development sites in the last 90 days. And I am actively looking for small multifamily for myself right now. All those strategies works as long as I'm getting the right buy on it. Flipping is very risky right now, guys, but the one good thing is the buy opportunity is way better than it was. I actually did not enjoy flipping the last 2 years. It was not logical, not reasonable. People are charging too much. Things were just, you were basically just praying that the market just went ripping for you to rack a return. Now you can do it based on math and the right plan. And so it's a way better way to invest right now. So things are kind of stabled out. But every strategy works. Like right now, flipping has slowed down. What that means is I've gotten way more deal flow. I have way more contractors that can work on it. I can get it done quicker. So there's pros and cons to each market right now. If you are really, if risk is a big deal to you guys and you don't want any type of risk going on, then yeah, stay away from those short investments. Go with long-term, buy and hold, keep onto it, refi it in 2 years and get your portfolio up. But the shorter the term the investment, the higher risk it will be. So we want better and better margins as we're buying these short-term high yield investments. Next question. Oh, right. New Orleans. I had a great time in New Orleans. I wish the Seahawks won, but we had a great time. Great food, great people, awesome city. It was a little wild, but it was awesome city. Any in-person meetups are great places to gain more knowledge for local real estate investing. Yeah, so you guys, we do our cash flow class, Investor 101. That is every month. We did one last night at our office, so make sure to come check us out there. In addition to, make sure that you have gone to our website, logged in, and that you subscribe and follow to our YouTube channels, because we're going to be doing some more live walkthroughs. We did a hoarders walkthrough the other day, about a couple weeks ago, where we walked through a whole house that we just bought and how we were handling the renovation. We have some luxury flips that we're coming to market with. We're going to do some tours on those to take people through how we kind of budget them and how we upgraded them. So just be in tune to what's going on our social media channels, and you will know when the meetups are. Cool. Well, I want to thank everyone for coming out. And then you guys, we will be doing this again next month. So be on the lookout for that. And if you have any questions, feel free to reach out to us online. And also, again, make sure to check out the On the Market podcast. We are going over these trends every week.